Welcome to the year 2026. The financial world is in a state of shock as gold prices shatter every historical record previously held for the first time in history. Gold has hit a staggering $1,600 per ounce, sending shockwaves through every major global trading floor. What started as a steady climb has transformed into an explosive bull market. That is redefining the very meaning of a safe haven asset. But why is this happening now? To understand the surge, we must look at the 5 massive economic forces driving this unprecedented global rally. The first major catalyst is global instability. Conflict zones around the world are lighting up, driving investors toward the oldest security known to man. As traditional currencies like the dollar, euro, and pound lose their luster, gold bars are rising as the only stable anchor in the storm. The inverse correlation is clear. As the strength of paper money fades, the intrinsic value of gold becomes the primary focus for institutional giants. But wait, there is a force even bigger than fear. Beyond the immediate panic, a structural shift in the global economy is taking place. Force number 1, central bank accumulation. Nations like China and India are aggressively diversifying their reserves, moving away from debt and into gold. These central banks are buying gold at a pace not seen in decades, providing a massive floor for prices that refuses to break. Force number 2 is the return of rampant inflation. As the cost of essential goods continues to climb, paper savings are being eroded daily. Investors realize that gold is the ultimate inflation hedge, preserving purchasing power when everything else is becoming more expensive and harder to afford. Force number 3, falling interest rates. As the Federal Reserve pivots to stimulate the economy, the yield on traditional bonds has plummeted. When interest rates are low, the opportunity cost of holding gold vanishes, making the precious metal the most attractive option for capital preservation. Force number 4 is the massive inflow into gold ETFs. Digital access has allowed billions of dollars to flood into the market instantly. Institutional investors and retail traders alike are now able to hold gold with the click of a button, creating a surge in liquidity. Finally, force number 5, geopolitical sanctions. Gold is a neutral asset that no single government can switch off or freeze in a crisis. In a fractured world, gold remains the only universal currency accepted by every nation, regardless of political, alliances, or economic sanctions. Experts at major institutions like J.P. Morgan and Ends Bank are already adjusting their forecasts, predicting even higher ceilings for the coming years. Some analysts are looking at a target of $800 per ounce, citing the 1970s gold boom as a historical blueprint for this cycle. But what about Bitcoin? Many investors are asking if digital gold can truly compete with physical gold during a genuine global crisis. While Bitcoin offers high growth, it also brings extreme volatility. In 2026, we see the digital asset side covered in dark, stormy clouds. Meanwhile, the gold side remains in stable, warm sunshine, proving its resilience as the ultimate store of value when the digital world falters. The message for investors is clear. We are entering a new era of wealth preservation, where physical assets are the ultimate foundation. A diversified portfolio that includes a significant gold position is no longer just an option. It is a necessity for survival in this market. Gold at $4,600 is just the beginning. The momentum is building, and the forces we have identified are only growing stronger. Will it hit $5,000 before the year is out? The data suggests that we are heading toward a historic conclusion to this bull run. Make sure to subscribe and stay tuned. as we track every move in the gold market and help you navigate the 2026 economic landscape.